Welcome to A to Z Forex weekly recap of February 8th. Hi, I'm Gwen, a senior project manager at A to Z Forex, and this week we will pay attention to the steep fall in oil prices, especially since these events have pushed a number of central banks to review their inflation targets. Some economists related price fall to oversupply, while some related it to low demand. But the truth is that it has all been part of a big power game between oil giant Saudi Arabia and the rest of the world. According to New York Times, Saudi Arabia has been trying to pressure Russia with the oil price tools to abandon their support for Syria. So the first question that comes to mind is how realistic is the Saudi Arabia-Russia oil deal? Well, it appears that Saudi Arabia and Russia officials have had a countless of number of discussions for the past several months, although it is not clear how direct the Saudis have been linking oil prices to the Syrian issue in these discussions. The Saudis think they have some leverage over Mr. Putin, since their ability is to reduce the supply of oil and possibly drive up prices, which is a clean and clear message. In a comment to the New York Times, a Saudi official commented the following: "If oil can serve to bring peace in Syria, I don't see how Saudi Arabia would back away from trying to reach a deal. How much or will Mr. Putin care about these not known discussions? But he has frequently demonstrated that he would rather accept economic hardship than bowing to outside pressures." A clear picture on his view can be seen from Ukraine as well. Despite Western sanctions imposed on Russia, Mr. Putin administration has not backed up in their military involvement in Ukraine. The second question that comes to mind is how much effect will the oil pressure have on Putin and Russia? As the fifth largest oil reserve holding country in the world, Saudi Arabia is a key player in OPEC, often with their major price moving actions. Indeed, it has been majorly due to the Saudis that oil prices have been on a free fall for the last several months, diving from $106 per barrel level in June 2014 to directly to the level of $43 per barrel in January 2015. It is not that the drop in oil prices was felt in Saudi Arabia, it is just economies of scale. With their massive oil reserves and much low production cost, Saudis have much bigger buffer zones. However, they still need to price oil to be over $100 a barrel to be able to cover the federal expenses. If the oil market sustains at its current level of $50 and $55 a barrel, Saudi will be having approximately $40 billion deficit in 2015. But the key is that Saudi will have about $733 billion in savings invested in low-risk assets outside Saudi Arabia, which can enable them withstand such drops for a few years. Meanwhile, the Russian economy does not accommodate such luxury. According to the New York Times, there have been meetings held in November between Prince Saud al Faisal, the Saudi foreign minister, and Mr. Sergei Lavrov, the Russian foreign minister, on various topics including oil and Syria. Reportedly, Mr. Lavrov rejected the idea of oil prices being subject to international politics. With that being said, this weekend there was a meeting between world leaders including the Russian foreign minister, Mr. Lavrov. For the first time in the last couple of months, Mr. Lavrov showed easing in their approach towards the crisis in Ukraine. Also, we've been seeing oil prices easing up for the last 2 weeks, jumping up as much as $10 per barrel. Could this mean that there is an unannounced agreement? Should we expect market reaction change? We shall watch the market carefully to be able to stay on the positive side. So once again, buckle up traders, as volatility is ahead. My name is Gwen Nong and stay tuned with A2ZForex.com for more essential news.